Video, we will discuss the liabilities and the equity section of the balance sheet, IFRS, and various ratios. Liabilities are classified as current or long-term. Current liabilities are obligations that are expected to be paid within the next 12 months or the operating cycle, whichever is longer. Long-term liabilities are obligations that are not expected to be paid within the next 12 months or the operating cycle, but in the more distant future. Walt Disney's current liabilities as of October 2, 2010 are comprised of accounts payable and accrued liabilities for $6,109 million. This balance represents amounts due to suppliers and other obligations still unpaid but due soon. Current portion of borrowings for $2,350 million needs to be paid in the near future. Unearned royalties and other advances are money received from third parties that have not been earned by Walt Disney. Walt Disney's obligations that need to be paid in the more distant future, or past the 12 months following the balance sheet date, are various borrowings for the amount of $10,130 million, deferred income taxes for $2,630 million, and other long-term liabilities for $6,104 million. The stockholders' equity section of the balance sheet is generally comprised of two sections, which are contributed capital and retained earnings. Capital stock is an account increased by the par or stated value of the shares issued. Additional paid-in capital account holds the excess amounts paid over the par or stated value. For example, if the par value of a common stock is $1 and the market price is $10, for the issuance of one share, common stock will increase by $1 and paid in excess of par will increase by $9. Retained earnings is the corporation's undistributed earnings, or net income less declared dividends. Sometimes we will see accumulated other comprehensive income, which is the aggregate amount of the other comprehensive income items, such as unrealized gains or losses from market value fluctuations for pension funds, also possible for foreign currency exchange transactions. We may also see treasury stock, which is the amount of money paid to repurchase corporations' own common stock. Non-controlling interests or minority interest is the portion of the equity of subsidiaries not wholly owned by the reporting company. This information will be reported in the stockholders' equity section if it is applicable to the corporation. Disney's shareholders' equity section shows that the company has preferred and common stock. Please note that the company states the par value and the number of authorized and issued shares. Par value refers to the stock value stated in the corporate charter. It is also known as a legal capital and enforces some restrictions for the corporation's management. They are defined and may vary depending on the state of incorporation. To minimize these limitations, corporations may select low amounts such as a cent or tenth of a cent. Authorized number of shares. This is the maximum number of shares that a corporation can issue. The number is stated in the corporate charter as well. Issued shares is the number of shares that already have been issued. This way, we can make a judgment what portion of the authorized shares the company has already issued. If all the authorized stock has been issued, then no more money can be raised from equity. We can see that as of October 2nd, Disney has not issued any of the preferred stock. Disney's common stock has 1 cent par value. On October 2nd, its authorized shares are 4.6 billion and issued shares are 2.7 billion. The balance in the common stock account is 28,736 million. This balance combines the par and the excess of par in its total. This conclusion can be made because 2.7 billion shares times 1 cent is much less than the shown balance. Disney's retained earnings as of October 2nd is $34,327 million. Accumulated other comprehensive loss equals to $1,881 million. Treasury stock is accounted for at cost. On October 2nd, Disney had 803.1 million shares for the total cost of $23,663 million. Please note that the treasury stock decreases the total equity. Non-controlling interest is for the total of $1,823 million. I wanted to show you an equity section that better separates the legal capital, which was par value, times the number of shares issued. Let's look at Las Vegas Sands Corporation. You can see that the balance in the common stock account equals the number of roughly 708 million shares times the $0.001 par value. The amount of cash collected from the issuance of stock would be the sum of the common stock and capital in excess of par value account balances, or $5,445,413. IFRS versus GAAP. Both IFRS and GAAP allow the use of title balance sheet or statement of financial position. IFRS, however, recommends the use of statement of financial position. Both IFRS and GAAP require disclosures about accounting policies and judgments used by management. Under IFRS, current assets are usually listed in the reverse order of liquidity. For example, under GAAP, cash is listed first, but under IFRS, it is listed last. IFRS has many differences in terminology. For example, in the equity section, common stock is called share capital ordinary. Advantages and disadvantages of raising funds through debt. The advantages are that funds are raised without giving up any ownership rights. The interest that is paid is an expense which decreases profits, which are taxed. Therefore, it decreases the amount of income tax paid and improves cash flow. The disadvantages are that the corporation has to have cash to pay the periodic interest payments. The least frequency would be once a year, and the principal has to be repaid at maturity. When equity is used to raise cash, the new owners have a right to vote on major issues and to receive assets upon liquidation, as well as dividends. Dividends may be paid or not, depending on the board of directors' decision. So the pros are that the corporation may decide to share or not some of the profits and do not have to deal with repayment of principal. The downside is that more opinions have to be considered. Some important ratios that are used are current ratio, which is computed as we divide the total current assets by the total current liabilities. It measures corporation's ability to pay its immediate obligations. If the company has a current ratio of more than 1, it is considered as favorable. More conservative analysts look for a current ratio of 2. For the purposes of this course, we will consider current ratio of 1 and more to be favorable. If current ratio is too high, for example 4 or more, analysts usually criticize management for lost opportunities. Debt ratio is total liabilities divided by total assets. It measures the portion of assets financed by debt, as previously discussed. The trend analysis shows consecutive periods compared to base period. You can see that Disney's total assets increased by 3% in 2008, 4% in 2009, and 14% in 2010 compared to 2007. All asset accounts increased compared to 2007 except for goodwill and intangibles in 2009, where they decreased by 3%. You can also analyze the changes in the non-current liability and equity accounts compared to 2007. Current liabilities increased by 2% in 2008, decreased by 22% in 2009, and 3% in 2010. Liabilities will decrease as the corporation pays in a more accelerated pattern and will increase when they enter in additional obligation or slow down their payments. Common stock increased each year, which means that Disney issued more stock. Retained earnings increased, which tells us that the corporation had successful and profitable years, and not all profits have been paid as dividends. The common-sized balance sheet shows the proportions of the various accounts compared to total assets. You can see that current assets represented 33% of the total assets for News Corp and only 18% for Disney. Property, plant, and equipment net of depreciation represents 26% for Disney and 11% for News Corp. This approach can be applied to all accounts for the same company in different periods or comparison of different companies. If different companies are being analyzed, please consider the industry under scrutiny. Thank you for watching.